Welcome to this video reviewing the amendments to the Income Tax Ordinance of 2001, covering changes made up to June 30, 2026 under the Finance Act of 2026. In this video, we will outline the scope of these amendments, categorizing them into key areas, including definitions, deductions, returns, compliance mechanisms, withholding taxes, and various administrative updates. The scale of this year's changes is significant, spanning over 839 pages. It includes over 30 newly inserted, omitted, or substituted sections, more than 90 edits at the subsection and clause level, and updates to 12 schedules. We begin with Chapter 1, covering preliminary definitions. Several terms have been added, such as algorithmic settlement mechanism, authorized shipping agent, electronically readable format, licensed integrator, National Faceless Center, and PRAL, while others like fast-moving consumer goods and special purpose vehicle have been omitted. Under Chapter 2, regarding the charge of tax, the tax on deemed income is omitted, while a new levy for the life insurance sector is introduced. Additionally, surcharge provisions have been amended to exclude certain salary earners. Regarding deductions and tax credits, Section 21R has been reworded. Section 53A introduces new rationalization for minimum tax rates, and Section 64D concerning tax credits for system integration has been completely rewritten. For capital assets and the taxation of entities, new rules define the cost of inherited property. Additionally, the definition of a person is broadened to include limited liability partnerships, and new taxation principles for associations of persons have been introduced. In terms of returns and special regimes, amendments to Sections 99B, 100B, and 114 have tightened income tax return rules and narrowed the non-active taxpayer regime, including changes to capital gain tax provisions. A major compliance and dispute architecture has been established. This includes 6 new sections introducing faceless audit and assessment under Section 122E, faceless appeals under Section 129A, independent case scrutiny committee under Section 133A, alternative dispute resolution under Section 134A, algorithmic settlement mechanism under Section 134B, and faceless jurisdiction of IR authorities under Section 209B. Updates to the departmental structure include the omission of Section 209A, the insertion of Section 209B for faceless jurisdiction of income tax authorities, and the creation of a new Directorate General for field compliance. The withholding tax regime sees changes in Sections 143, 144, 147, and 6A, with specific updates affecting non-resident ship and aircraft owners, advanced tax computations, and digital transactions on e-commerce platforms. Continuing with the withholding tax regime, new sections target life insurance and takaful payments, as well as revenues from social media platforms. There are also changes to non-resident payment rules and reporting obligations for financial institutions. Powers regarding search and audit are updated in Sections 174, 175AA, and 177. These changes include revised record-keeping procedures, expanded data sharing scope for high-risk persons, and updates to the audit selection framework. Sections 182 and 182A address offenses and penalties. This area contains significant updates to the penalty table, including revised figures and new items, as well as changes to the return filing deadline penalty structure. Various other administrative changes cover disclosures by public servants, the appointment of experts, the replacement of the automated impersonal tax regime with the National Faceless Center, and minor adjustments to other advanced tax provisions. Moving to the first schedule, this video highlights that the super tax table for high-earning persons has been substituted. This includes a newly recast graduated slab structure for banking companies, certain specific persons under the 5th schedule, and fertilizer sale income. Several rate divisions have been structurally rewritten across Parts 1, 3, and 4. Key updates include the omission of tax on deemed income, the introduction of a new division for life insurance and takaful payments, and revised rates for transactions involving immovable property. The second schedule, Part 1, regarding exemptions, has undergone several clause-level changes. Notably, the Pakistan Education Endowment Fund reference has been substituted, and a new block of serial numbers from ILII to LXII has been added to the exemption list. The second schedule also includes further edits in Parts 2 and 4. These changes involve updates to eligibility wording for reduced rate clauses, the withdrawal of certain exemptions, and the insertion of a new exemption clause for specific qualifying entries. Rounding out the amendment package, the 8th, 10th, and 12th schedules feature sector and compliance-specific rules. These include the withdrawal of certain capital gains computation rules and non-filer withholding provisions, alongside the insertion of a new tariff code for imports. To summarize, these amendments impact various facets of tax compliance, from the shift away from deemed income to new industry-specific levies, and the rollout of faceless audit and appeal mechanisms. Thank you for watching this overview of the Finance Act 2026 amendments. For further professional assistance or detailed guidance, please reach out to T.M Tax Consultants through our website, via email, or on our social media platforms. Please don't forget to subscribe and like our channel. Thanks.